The letter satisfies. Arrive on a Tuesday, not a phone call. Not a visit, just a single piece of paper in a white envelope. Sitting quietly in the mailbox between a credit card offer and a grocery flyer. We regret to inform you that your homeowner's insurance policy will not be renewed. Across Los Angeles, thousands of families are opening this exact letter. Same cold language. Same polite refusal. Same devastating consequence. Your home, the one you saved for, sacrificed for, built your entire life around, is now uninsurable. Not because you missed a payment. Not because you filed too many claims. Not because you did anything wrong at all. Simply because of where you live. In Pacific Palisades alone, State Farm dropped over 1,600 policies in July 2024. 1,600 families. One decision. No negotiation. 6 months later, the Palisades Fire would burn those same neighborhoods to the ground. But here is what most people do want to understand. The insurance companies did want to abandon these homeowners because of the fire. They abandoned them before the fire. They saw something coming that the homeowners couldn't see, or maybe didn't want to see. The question is, what did they know? And why didn't anyone listen? This is the story of how Los Angeles became the city where your home can be worth $4 million and still be worthless on paper. Because a house without insurance isn't really a house anymore. It's just an expensive bet against the weather. Let's start with a number that sounds impossible until you realize it's actually conservative. $45 billion. That's the high-end estimate of insured losses from the January 2025 wildfires. Not total losses, just the insured portion. To put that in perspective, the previous most expensive wildfire in American history cost insurers about $11 billion. Los Angeles quadrupled that record in a single week. But the insurance crisis didn't begin in January 2025. It began years earlier, building slowly, invisibly, like pressure in a fault line. In 2023, State Farm announced it would stop writing new homeowner policies anywhere in California. The company cited historic increases in construction costs, catastrophe exposure, and a challenging reinsurance market. Translation: the math stopped working. Allstate followed. Then farmers, then dozens of smaller carriers. One by one, the companies that had insured California homes for generations began backing away. Not from bad neighborhoods, not from risky clients, from the entire state. By 2024, the California Fair Plan, the state's insurer of last resort, designed as a safety net for the highest-risk properties, had grown from 200,000 policies to 452,000. More than doubled in 4 years. In Pacific Palisades specifically, 1 in 7 homes was on the Fair Plan by September 2024. These weren't substandard houses. These were multi-million-dollar properties that no private company would touch. The average Fair Plan policy costs around $3,200 per year, more than double a standard policy. And that's just for basic coverage that often falls far short of actual replacement costs. One lawmaker said it plainly at a hearing in March 2024. "I am concerned that we re-one bad fire season away from complete insolvency." He didn't know how right he was. Francis Biscetti had a choice to make. His homeowner's insurance renewal, quote, had arrived. The previous year, he'd paid $4,500. Standard rate for a nice home in a good neighborhood. The new, quote, $18,000. 4 times the price, for the same coverage, same house, same address, same everything, except the insurance company's calculation of risk. Biscetti did what a growing number of California homeowners were doing. He ran the numbers. He weighed the odds, and he decided to go bare. No insurance, no safety net, just the house, the mortgage, and a gamble that nothing would go wrong. In Pacific Palisades, his decision wasn't unusual. It was becoming normal. Thousands of homeowners across fire-prone areas were making the same calculation. The premiums had become so astronomical, the coverage so inadequate, that paying felt like throwing money into a hole. If you're paying $40,000 a year for insurance, and yes, some homeowners were quoted that much, the math starts to feel absurd. That's $400,000 over a decade. You could rebuild a significant portion of your house for that amount. And besides, what were the actual odds of a catastrophic fire hitting your specific property? Pretty low, right? Francis Bischetti's house burned to the ground on January 7th, 2025. He wasn't alone. Across the burn zones, an unknown number of homes were completely uninsured when the fires hit. Not because the owners couldn't afford insurance, because they'd made a bet, and they lost. Even the homeowners who kept their insurance discovered something devastating when they tried to rebuild. The coverage wasn't enough. Not even close. The median home price in Pacific Palisades before the fire was $4 million, but the average insurance payout for a destroyed home? Around $2.50 to $3 million. If you were lucky enough to have full coverage, that gapped $1 million or more wasn't an accident. It was built into the system. For years, insurance companies had been quietly adjusting their coverage limits. As home values skyrocketed, policies often stayed flat or increased only marginally. Homeowners who didn't read their renewal documents carefully found themselves dramatically under. But even those with seemingly adequate coverage faced another problem. Replacement cost doesn't equal purchase price. Rebuilding a home in a disaster zone costs far more than building one under normal circumstances. When thousands of homes need reconstruction simultaneously, the laws of supply and demand take over. Contractors become scarce. Materials become expensive. Labor costs spike. Post-disaster construction, inflation, what insurance companies call demand surge, can add 15 to 30% to rebuilding costs. Sometimes more. One expert put it bluntly. Let's say California Fair actually manages to pay out these insurance policies. The rebuilding costs is going to be much more than that, $2.50 to $3 million, because every contractor is going to be tapped. This is what happened in New Orleans after Katrina. So even homeowners who dutifully paid their premiums for years, who did everything right, found themselves facing a devastating question. How do you rebuild a $4 million home with a $3 million check in a construction market where prices are climbing by the week? The answer, for many, is you don't. 1 year after the fires, the streets of Pacific Palisades tell a story that statistics alone cannot capture. Where houses once stood, there are now dirt lots. Cleared. Empty. Waiting. Lily. Less than 20% of homeowners who lost everything had closed out their insurance claims. 80% were still waiting. Still negotiating. Still fighting for money that should have been straightforward. Actual rebuilding. Almost non-existent. Estimates suggest that fewer than a dozen homes in Pacific Palisades had been fully rebuilt 1 year after the disaster. In Altadena, where the Eaton fire devastated a middle-class community, the numbers are equally bleak. More than 70% of residents in both areas have not returned to their homes. The reasons form a perfect storm of bureaucratic paralysis. Insurance companies, facing unprecedented claims, have slowed their processes. Adjusters are overwhelmed. Disputes over coverage amounts drag on for months. Every destroyed home requires documentation that no longer exists. Photographs, receipts, appraisals. How do you prove what you owned when everything you owned is ash? Meanwhile, the regulatory environment has created additional delays. Environmental reviews, permit approvals, coastal commission requirements. Each layer adds weeks or months to the timeline. Governor Newsom suspended some requirements to speed rebuilding. It hasn't been enough. As of October 2025, only 758 permits had been approved in Pacific Palisades and 568 in Altadena. That's less than 10% of the homes damaged or destroyed. The families who want to rebuild face an agonizing choice, wait in limbo, burning through savings on temporary housing, hoping their insurance settlement eventually covers their costs, or give up. More than 600 properties where homes were destroyed have already been sold, many to investors who can afford to wait years for the market to recover. The communities that existed before the fire, with their young families, their longtime residents, their neighborhood networks, are dissolving. One community organizer said it simply: that community won't be the same again. It will be an entirely new one. The Palisades Fire and the Eaton Fire burned at nearly the same time. They destroyed roughly similar numbers of homes. They created similar amounts of suffering, but the recovery has been dramatically different. Pacific Palisades is one of the wealthiest neighborhoods in America. Median home prices before the fire exceeded $4 million. Residents included celebrities, executives, and old money families who had lived there for generations. Altadena, by contrast, is a working-class community. More diverse, more modest. Homes worth a fraction of their Palisades counterparts. On paper, Palisades residents should be recovering faster. They have more resources, more connections, more financial cushion to survive extended displacement. The reality is more complicated. In Palisades, homeowners can afford to wait. They can rent expensive temporary housing nearby. They can hold out for better insurance settlements. They can hire lawyers to fight for every dollar. In Altadena, families don't have that luxury. 25% of Eaton Fire victims were renters. Half of those were already rent-burdened, spending more than 30% of their income on housing before losing everything. For them, there's no settlement to negotiate, no rebuild to plan, just displacement. One economist described the divergence. People in the Palisades are probably a lot better able to wait it out. But people in Altadena, it's a more working-class neighborhood. They're probably under a lot more financial pressure to just sell, take whatever they can get from an investor. The fires didn't create inequality in Los Angeles. They exposed it, amplified it, made it impossible to ignore. Two neighborhoods, shame, disaster, completely different futures. And in both places, insurance, or the lack of it, is determining who gets to come home. Here's what the insurance companies understood before everyone else. The January 2025 fires weren't an anomaly. They were a preview. Climate change has fundamentally altered fire behavior in California. Hotter temperatures, drier vegetation, longer fire seasons, more extreme wind events. The Santa Ana winds that drove the Palisades fire reached hurricane force to 100 miles per hour in some areas. Fire crews were helpless against that kind of power, and the conditions that created those winds. They're becoming more common, not less. 7 of California's 10 most destructive wildfires have occurred in the last 10 years. The trend line is unmistakable. Insurance companies aren't in the business of sentiment. They're in the business of probability. And the probability models for California wildfire risk had become terrifying. That's why they're leaving. Not because they're heartless. Not because they're greedy. Because the math, the cold, actuarial, unavoidable math, no longer supports insuring homes in fire-prone areas at prices people can afford. California's insurance commissioner has tried to force companies back into the market. New regulations require insurers to offer policies in high-risk areas if they want to do business anywhere in the state. But regulations can't change physics. If a company offers policies at affordable rates in areas where losses are guaranteed to exceed premiums, that company goes bankrupt. And a bankrupt insurer helps no one. The fundamental problem isn't corporate greed or regulatory failure or political incompetence. The fundamental problem is that millions of homes have been built in places where fire is not a possibility but an inevitability. And no piece of paper, no policy, no premium, no government mandate can change that geography. There's a question that nobody in power wants to ask out loud. Should some places simply not be rebuilt? The homes destroyed in Pacific Palisades sat in one of the most fire-prone landscapes in North America. Steep terrain, dense vegetation, perfect wind corridors for carrying flames. Before the fire, more than a third of properties in the area had been cited for failing to clear brush from their land. Some had been cited multiple times. The location wasn't dangerous despite these factors. It was dangerous because of them. One expert put it bluntly. It's human hubris that we can ignore Mother Nature. My view isn't about how to rebuild to be more resilient, but how to think about whether there are places that we COA or should UNT rebuild. But that's not a politically viable position. These aren't empty lots in the wilderness. There's some of the most expensive real estate in America. The homeowners aren't abstractions. They're voters, taxpayers, community members with deep roots and loud voices. Telling them their neighborhoods shouldn't exist isn't a platform any politician wants to run on. So instead, we get rebuilding incentives, streamlined permits, promises that next time will be different. California is spending billions to help people return to the exact same places that just burned, often to rebuild the exact same types of structures, with the exact same vulnerabilities. The insurance companies see this cycle clearly. That's why they're not coming back, regardless of what regulations require. They've done the math on what happens when you rebuild in a fire corridor and wait for the next Santa Ana wind event. The homeowners are betting that lightning won't strike twice. The insurance companies are betting that it will. Only one of those bets can be right. A year after the fires, the California insurance market exists in a strange, suspended state. Commissioner Lara issued a 1-year moratorium on cancellations and non-renewals in fire-affected areas. That moratorium bought time. It didn't solve anything. The FAIR plan, the insurer of last resort, is straining under the weight of claims it was never designed to handle. The plan had $5.9 billion in exposure in Pacific Palisades alone before the fire. Paying out those claims while maintaining solvency is a mathematical challenge that hasn't been fully resolved. Meanwhile, the homes that weren't destroyed face their own crisis. Owners seen fire-adjacent neighborhoods are finding their policies canceled or priced into impossibility. The ring of uninsurable territory is expanding outward from the burn zones like ripples in a pond. For the broader real estate market, insurance has become the hidden variable that determines everything. A home that can't be insured can't be mortgaged. A home that can't be mortgaged can only be purchased with cash. A market where only cash buyers can participate is a market that excludes ordinary families. This is already happening. Investors are purchasing fire-damaged lots at a rate of roughly 40%. They can afford to wait. They can afford the risk. Individual families cannot. The community that eventually emerges from these ashes may look very different from the one that burned. Wealthier, more corporate, less rooted, and the lessons of the Palisades Fire are not staying in the Palisades. Across California, across the entire American West, homeowners are beginning to ask questions they never thought they'd need to ask. Can I afford to stay here if my insurance doubles? What happens to my retirement if my home becomes Is my house an asset or a liability? These questions have no good answers. The insurance crisis has revealed a fundamental mismatch between where Americans have built their lives and where it is actually safe to live. Los Angeles didn't create this problem, but Los Angeles is showing everyone what happens when the bill comes due. The fires of January 2025 burned 4 weeks. The insurance crisis they exposed will last for decades, and the hardest question of all remains unanswered. If your home can't be insured, if your neighborhood keeps burning, if the companies designed to protect you have walked away, who exactly is supposed to help you now?